Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 96, we're going to talk about situations where a trust might be a non-grantor trust. And we've talked a lot in the past about grantor trusts and their benefits, but what we haven't really dived into is the fact that the grantor trust status could be terminated at some point in the future by the grantor if they so desire. But as we're going to find out, that may be a little more difficult than anticipated in a situation where the spouse is a beneficiary of the trust. So we're going to dig a little deeper on that point, but as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, when it comes to gift planning, especially estate freeze style gifts, typically there's an irrevocable trust that's structured as a grantor trust, which means that the grantor, the creator of the trust, is taxed on all of the trust income, and by paying the income tax of the trust, it results in a situation where there's a transfer free of gift tax. In other words, the payment of the trust's income tax doesn't cause the grantor to make a gift to the trust beneficiaries. So that's one of the big benefits of a grantor trust, besides the income tax rate arbitrage when you compare the tax brackets of a trust, which are highly compressed, to the broader rates for an individual such as the grantor. However, usually with a grantor trust, the way that you can really pitch this to a client is the fact that a grantor controls when the grantor trust status can terminate. So if the grantor got sick of paying income tax on trust income, then the grantor could release some sort of retained right or power and cause the trust to now be a non-grantor trust, meaning that the trust would simply pay all income tax on its income. And this would simply be an administrative power, usually, such as the right to substitute trust assets with grantor's assets of equivalent value. Now, the problem with that situation is that it's not as simple as just releasing an administrative power if the spouse of the grantor is a beneficiary. That would be the case with a trust like a SLAT or a QTIP, and in that situation, what we're going to find out is a simple release of an administrative power doesn't terminate the grantor trust status so long as the grantor's spouse is a beneficiary. Now, this code section specifically calls out the administrative powers under code section 674 and says that even if the grantor doesn't have any administrative powers, the trust is still a grantor trust so long as the spouse is a beneficiary with certain beneficial interests. But you may be asking yourself that if income drives grantor trust distributions, could you simply cut off the income distributions to the spouse and limit the spouse to principal distributions? And the answer is no. The reason is that Code Section 677 contemplates not only income that may be distributed to the grantor's spouse, but it also contemplates income that may be accumulated for future distribution to the grantor's spouse in a year other than the year in which it's taxed or earned. Now, what's implied in future distribution is that that accumulated income is added to principal. And for that reason, generally, if the spouse can receive principal distributions from the trust, that would also cause the trust to be treated as a grantor trust, which is why you can't cut off just income. You'd have to cut off both income and principal. Now, notably, one issue in this is that even though capital gains could be allocated to principal, they would still be an item of income that's considered under Code Section 677, even though they're not an item of accounting income for purposes of calculating the D&I distribution deduction for the trust if it's a non-grantor trust. So, if you're in a situation where you've got a spouse as a beneficiary, how can you structure this in a way where the trust could be a non-grantor trust, but also allow the spouse to receive some benefit and not be completely cut off? And the answer lies in looking to adverse parties within the trust itself. Now, Code Section 677 is really driven by the discretionary distribution decisions of a trustee. Now, notably, under that code section, If you allow an adverse party to have the consent to veto or approve trustee decisions, that's not enough to keep you from having a grantor trust, because the code section speaks to situations where income is distributed or accumulated maybe with the consent of an adverse party. But if the adverse party themselves is making the decision, then you may be able to get away with making principal distributions to the spouse. So what you have to do here is have a situation where an adverse party acts alone in a non-fiduciary capacity. In other words, the adverse party is not acting as a trustee. They're a beneficiary, as we're going to find out, but they have a power to distribute principal to the spouse in a non-fiduciary capacity, which is akin more to a power of appointment instead of a discretionary distribution right held by the trustee. So generally, you're going to want an adverse party who is a beneficiary with a substantial beneficial interest. Preferably, that would be the right to receive discretionary income and principal distributions. Now, you don't want to limit that by a fraction. You'd want the trustee to have the discretion maybe to send a lot of income and a lot of principal to that adverse party beneficiary. Now, you could do this with the pool of existing beneficiaries, such as children and descendants, but the problem is that any children or descendants who are under the age of 18 would have to get the consent of their parents too, who would be the grantor or the grantor's spouse. So that would still be a power that is retained by the grantor or the grantor's spouse, which would keep this from being a non-grantor trust. So if your other beneficiaries are not adult children or adult descendants, what you might have to do is add beneficiaries such as parents or siblings of the grantor or the grantor's spouse who have a secondary right to receive income and principal distributions, but also have that right to appoint the principal to the spouse. And by doing that, you may be able to get around this retained beneficial interest issue with a spouse that would otherwise keep a trust from being a non-grantor trust, so long as the spouse is a beneficiary. So when it comes to the practical application here, it's important to note that if you are trying to do this midstream with a trust that's already been created, the trust is irrevocable, and you may not be able to decant or modify to add this adverse party principal distribution type of language. Because for one, the spouse giving up the right to income and or principal could be a gift to the other trust beneficiaries, which is its own separate issue. But two, the IRS may not be bound by such a change either. So it's better to put this language in the trust from the outset instead of trying to add it later, if it's contemplated that a trust with a spouse as a beneficiary might want to be a non-grantor trust in the future. And further, if you have a trust such as a QTIP trust where you have to distribute income, then you may have to make it a grantor trust with respect to income, but it may be a non-grantor trust with respect to principal by just simply saying the spouse can receive income but not principal. And that means that capital gains would be taxed to the trust and not to the grantor. You could also switch that and say that maybe the spouse has the right to withdraw all income, which would still qualify the trust as a QTIP trust, but would keep it from being a grantor trust with respect to income. But the problem is that the unwithdrawn income would be added to principal, so the trust would still be a grantor trust with respect to the principal. That would really just be a switch. So you could go either way with the QTIP trust, but you'd have to have it grantor as to part and non-grantor as to the other part. Otherwise, you couldn't qualify it as a QTIP trust. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.